financial accounting, a transaction is a financial event that involves an exchange of economic value between two or more parties, which can be measured in monetary terms and occurs as a result of decision of the entity. Economic value refers to the measurable benefits in monetary terms exchanged between parties in a transaction. It means something of financial significance is given or received. Example: buying goods worth of $1,000 for cash. Economic value given: cash of $1,000. Economic value received: goods worth of $1,000. Though it is termed transaction analysis, events are also considered in transaction analysis. Non-exchange events which have a financial impact are defined as events. Examples: depreciation of an asset, loss due to natural disasters. Example: fire, flood, etc. Every transaction or event has a dual impact as per the double entry system on assets, liabilities, and equity. Example: one debit and one credit. Transaction analysis is the process of examining a financial transaction or event to determine its dual impact on the assets, liabilities, and equity or accounting equation, and double entries to record it properly in the books of accounts. Accordingly, the steps of transaction analysis are identifying the accounts affected or the nature of the accounts, classifying them as assets, liabilities, equity, revenue, or expenses, determining whether each account increases or decreases, applying the rules of debit and credit to record the transaction, determining the journals and ledgers to record the transaction or books of accounts. Let's take a simple transaction and analyze it following each stage of transaction analysis in accounting. A business purchases office supplies worth of $5,000 in cash. It's a transaction. Step 1. Identify the accounts affected. Office supplies, cash. Step 2. Classify the accounts into respective accounts type. Office supplies is an asset. Cash is an asset. Step 3. Determine the dual impact on the accounting equation. Office supplies asset increase, cash asset decrease. The dual impact can be presented on the accounting equation as assets plus assets minus. Step 4. Apply debit and credit rules. Office supply asset increase is a debit. Cash asset decrease is a credit. Step 5. Determine the journals and ledgers to record the transaction. Journal, cash book, ledger, general ledger. Transaction analysis is a fundamental process in accounting that ensures accurate financial recording and reporting. Its importance includes transaction analysis identifies which accounts are affected by a transaction, determines how much each account changes, that is, increase or decrease, prevents errors like omissions or misclassification. Example: instead of wrongly debiting expenses for a utility payment, analysis helps correctly identify and debit utility expenses. Every transaction has dual effects, that is, at least one debit and one credit. Ensures the accounting equation, that is, assets equal liabilities plus equity, remains balanced. Example, buying equipment for cash, debit equipment account, credit cash account. Proper transaction analysis ensures correct posting to ledgers. It helps to generate accurate balance sheet, income statement, cash flow statement. Transaction analysis is the backbone of accounting, ensuring accuracy, compliance, and reliability in financial reporting. Without it, financial statement would be unreliable, leading to poor decisions, legal issues, and financial losses. I hope this helped you to understand what transaction analysis is and its importance in the financial accounting process. Keep practicing, stay curious, and let accounting work for you. See you in the next video.